As most of you know, I was out in June as I underwent back surgery. So for the most part of June, I was gone. But I'm trying to figure out which was more painful, my back surgery or watching the stock market drop in June. Well, this is Steve Wolf, and I'm here again with our monthly market review. And today we're going to review what happened in the month of June. To say the least, the bears were definitely in charge. The S&P was down around 8.6% in June. The Dow Jones was down somewhere around 6.7%, and the NASDAQ was down around 9%. Now, this is now the worst first half of the year for developed market equities in over 50 years. The S&P index dropped in the first half almost 21%. The Dow Jones was down about just under 16%, and the NASDAQ was down about 30%. Now, this doesn't mean that it was the worst ever drop. It's just the worst first half of the year. Now, only 8 of the Dow Jones stocks were positive for the first half of 2022, according to an article from Benziga. Now, if you want to know who the stocks were, which stocks they were, Chevron, Merck, Amgen, Travelers, Coca-Cola, IBM, Johnson & Johnson, and United Healthcare. You know, now is probably a good time to read my monthly disclaimer. Whatever is being said here is for informational purposes only, and it's not meant to be a recommendation. Before you buy or sell anything related to anything I'm saying about the markets or individual securities, be sure to consult your financial advisor to ensure it's the best recommendation for your personal situation. Now, if you are looking for relief from the stock market by purchasing bonds, well, forget about it. According to an article by Reuters, U.S. Treasuries, which is basically the global fixed income benchmark, have delivered total year-to-date losses of 11%, setting them on the course for the worst year on record, according to a Bank of America index tracking 7 to 10-year Treasuries since 1973. It also marks the worst first-half performance since 1788. 1788, according to Deutsche Bank. Now, how they know that, I have no idea, and I'm not really sure. But let's just say this has been a bad first half for bonds, too. Even real estate prices have been coming down. I recently went onto Zillow and looked to see how my local market was faring, and for the first time in a long time, I have seen price cuts on homes that were for sale. Now, I found a couple of charts from the company named FactSet. And that list, they're listing the worst performing stocks in the S&P 500 index this year. Now, first, here are the 10 companies whose market capitalizations dropped the most during the first 6 months in 2022. Now, they're not necessarily the worst performers in the benchmark index on a percentage basis, but these companies are so large that their market values have plunged the most. So here are the companies. Apple, Amazon, Microsoft, Alphabet, which is Google, Meta, which is Facebook, Tesla, Nvidia, Netflix, Home Depot, and PayPal Holdings. And just to give you an idea how much their market cap changed, Apple was down approximately $700 billion in value. Amazon down $610 billion. Microsoft, $604 billion, Alphabet, $579. You get the idea, and you can see that these are all the growth stocks that really have taken a really big hit. So you can see why growth stocks have done a lot poorer than some of the value stocks. Now, here's another 10 stocks in the S&P that have fallen the most during 22 on a percentage basis. Again, here are the 10 stocks. We have Netflix, Etsy, Align Technology, PayPal Holdings, Bath & Body Works, Caesars Entertainment, Carnival Corp, EPAM Systems, Ceridium HCM Holdings, and Royal Caribbean. And just to give you an idea how far they dropped, Netflix was off 71% so far in the first half of the year. Etsy down 66.6%. Align Technology down 64%. PayPal down 63%, etc. So you can see it's been a rough time. The markets have really taken it on the chin. Now, we talked a little bit last month about the fact that the price to earnings ratios were falling. Barron's magazine is estimating the PE, remember that's the price divided by earnings, on the S&P 500 is now down to around 16, which is really about average for the S&P 500 over a long period of time. Now, that doesn't mean stocks can't get cheaper from here. They can. But it seems that stocks are getting back to a little bit more normal valuation. Now, CNN has a fear and greed indicator. That indicator, according to CNN, has now entered the extreme fear zone. Now, to me, this is a positive. As we discussed last month, extreme conditions in the stock market rarely last for a very long time. Again, it doesn't mean we're at the bottom of the market, but it tells me that we're a lot closer to the bottom of the market than we are to the top. And if you listen to many commentators on TV and radio, they're almost all predicting the market is going much, much lower. Again, I see this as a positive because when everyone seems to be coming to the same conclusion, usually things don't work out that way. Now, I don't want anyone to misread me in any way with what I'm saying. I think the market could go lower. I think it's possible that we're entering a recession. We might even be in a recession right now. If you look at the bond market, the yield curve is very flat and looks like it might invert. In other words, the yields on bonds from 1 year to 10 years out are almost all the same. They're around 2.8, 2.82%, something in that range. When the short-term yields rise above those of the long-term, that's known as an inverted yield curve, and oftentimes it represents that we're going into a recession or that we're already in one. But I just think that because the market is a forward-looking instrument, I think a lot of it is already priced. A lot of the bad news is I think is already priced into the market. I tend to discount the doomsdayers who say we're going much, much lower. When I look at the PE, the price to earnings ratio, of many stocks that are right now down to single digits, it's really hard for me to believe that we're going much, much lower. Now remember, if the earnings part of the equation keeps going down, then stocks could very well adjust lower until the PEs are seen to be representing the true picture of the overall market. I do think it'll take some time for the market to repair itself, but I'm not in the doomsday camp. No one knows for sure, and I guess we'll see over the next few months what transpires. There are many indications that the economy is already slowing down. If that is the case, I would think that the Federal Reserve might have to rethink what they're doing with rising rates. Now, it's possible that a 75 basis point rise is already baked in the cake. But again, if the market starts slowing down, they're going to have to rethink. The 5, the 7, the 10, the 20, and 30-year rates have actually been falling recently. So the bond market seems to be indicating a slowdown is happening. A possible slowdown might also cause energy prices to go down, and that would be a really good thing as gas and oil, just they affect everything. Now, there's two other reasons I've been feeling a lot more optimistic. First, I finally am receiving my patio dining table and chairs after waiting 9 months to get them. Secondly, my back is recovering nicely from surgery. Much of the pain is gone, and in a couple of weeks, I'll be able to get rid of my back brace and start being able to bend and twist again. So by mid-July, in the words of the Beatles, I'll be able to twist and shout again. Well, that wraps up the June 2022 review. We'll see you again next month when we'll review what happened in July. Until then, happy investing.